Ladies and gentlemen, we're running a few minutes ahead of schedule, and that's not a bad thing. Ladies and gentlemen, directors, members and guests, it's my distinct honor to introduce our very distinguished guest speaker, Governor Mark Carney. Through his years of public service and influential thought leadership, Governor Carney has received global recognition and acclaim both for himself and for the Bank of Canada. Governor Carney was born in Fort Smith, Northwest Territories. He holds a bachelor's degree in economics from Harvard University and a master's degree, as well as a doctorate in economics from Oxford University. Prior to entering public service, Governor Carney had a 13-year career with Goldman Sachs, with postings in London, Tokyo, New York, and Toronto. In August 2003, Governor Carney was appointed Deputy Governor of the Bank of Canada. A year later, he was seconded to the Department of Finance. And in November 2007, he returned to the bank to begin the transition to his current role. On February 1st, 2008, Governor Carney was appointed Governor of the Bank of Canada for a term of 7 years. In addition to his duties as Governor, Governor Carney serves as Chairman of the Board of Directors of the Bank of Canada and Chairman of the Financial Stability Board. He's also on the Board of Directors of the Bank for International Settlements, the Group of 30, and the Foundation Board of the World Economic Forum. Governor Carney has received broad recognition as a global leader in financial policy, appearing on multiple media lists, including Central Bank Governor of the Year in 2012. But as a CFA charter holder, I particularly appreciate the Governor's progressive leadership in transforming the Bank of Canada into a modern institution, one that has led the global movement toward more transparency in central bank policy, and which takes an anticipatory and macroprudential approach to identifying and regulating sources of risk to financial stability. So without further delay, and with great pleasure, please join me in welcoming Governor Mark Carney.
Thank you very much, Phil. Thanks all of you for first inviting me and then showing up to listen to me. You may live to regret it, but I want to just off the start say that, look, I'm going to give a speech about guidance. That's the topic of the speech. But before I do, I want to dispel some of the misconceptions about CFAs. I mean, we all know that you're numerous here in Canada, and again, thank you for coming, but you do have a reputation as being a little dry, a little analytic. And so while I worked very hard on this speech, I hope it shows, I neglected to put a joke in at the start. And but I thought, well, you know, CFAs, they're a funny group. I'll just ask my table for a joke about guidance, because that's the topic, and everyone has a joke about guidance in their back pocket. And I'm proud to say that actually there were a couple competing jokes from my table, and this is the winner. And it's a story, I'm sure this has happened to some of you, happened to me, about a guy who goes out, has a late night, happens from time to time. It doesn't happen anymore, by the way, to me, just for avoidance of doubt, and has a late night, but is committed to going ice fishing. In the morning, gets up 4 a.m., gets in his car, drives to the ice, gets out, gets the auger, and goes to drill through the ice, and he gets started, and then he hears his voice, which says, "Sir, there are no fish beneath that ice." He stops. Kind of weird. Takes a breath. Starts again. Same voice. "There are no fish beneath that ice." Thinks, wow, God is trying to guide me. So he moves to a different part of the ice, fires up the auger again, and once again is admonished, "Sir, there are no fish below that ice. I'm the rink manager. There are no fish anywhere." There you go. Funny group, the CFAs. There you go. I told my table I would take credit for that joke if you laughed, and I would assign it otherwise. But guidance in part is about responsibility, so that would have been the wrong thing to do. Guidance is fundamentally about managing expectations, so I would like to manage yours up front. This speech is primarily about policy guidance. It will not itself provide any new policy guidance. All of us do need guidance from time to time. We look to our parents, our partners, our peers for their help in making life, career, or major financial decisions. But ultimately, those decisions are ours to make, and the consequences are ours to bear. I hope you agree, and I think you would, that taking responsibility is why many of you became chartered financial analysts, to learn how to analyze information, to make difficult valuation and credit decisions, and to bear the risks and reap the rewards that result. Without accurate and full disclosure from the companies you analyze, you couldn't do your jobs. And indeed, financial markets couldn't do theirs of bringing together savers and investors to allocate capital efficiently. With more CFA charter holders per capita than any other major jurisdiction, Canada is favored by such an emphasis on fundamental analysis at the core of our financial system. Today, I'd like to go a bit beyond disclosure to ask what else can be usefully conveyed to markets. Does the communication of companies' expectations of performance serve a purpose? And what about central bank communications or expectations about future policy? In my remarks, I'm going to discuss where such guidance can be effective and when it may be warranted. And my main message is that while transparency is critical to well-functioning capital markets and to effective monetary policy, forward guidance is best used sparingly in normal times. But in extraordinary times, conditional guidance can be used to resolve time inconsistencies and to achieve a better path for the economy. Voici les points clés de mon discours aujourd'hui. Pour atteindre ses objectifs de politique monétaire, une banque centrale doit être transparente relativement à ce qu'elle cherche à accomplir et à la façon dont elle s'y prend pour y parvenir. En temps normal, la banque doit orienter sa politique monétaire de façon à ce qu'elle s'adapte à l'évolution des conditions économiques. Elle ne peut donc pas prévoir cette orientation avec certitude à l'avance. C'est pourquoi l'efficacité des indications fournies par la banque se limite aux circonstances relativement spéciales. Et c'est dans des circonstances extraordinaires qu'il peut être le plus utile de fournir des indications au sujet de la politique monétaire. Et elles peuvent être extrêmement efficaces, comme la Banque du Canada l'a démontré à l'aide de son engagement conditionnel. Cet engagement a donné les résultats escomptés du fait qu'il était exceptionnel, explicite et arrimé à un régime de ciblage de l'inflation très crédible. Cependant, dans des circonstances plus extrêmes, il se peut que même un engagement conditionnel soit insuffisant. So allow me to address the private sector's use of guidance and its impact on financial markets. An ongoing focus of regulators has been to ensure that company disclosure is fair, full, and timely. And this crisis demonstrated the need for better disclosure by financial institutions, because insufficient and inconsistent disclosure added to uncertainty and eroded market confidence. And this led to a withdrawal of liquidity, depressed valuations, and increased funding pressures on banks. Regulators and market participants are addressing these shortcomings. An enhanced disclosure task force was formed last May at the initiative of the FSB. In its October report, this task force outlined principles and recommendations for improved risk disclosures by banks that are better aligned with the bank's risk management and business strategies. Together with other regulatory initiatives and with capital increases, these measures will contribute to improved market confidence in financial institutions over time. That companies should communicate material facts about their businesses and to do so to everyone at the same time is no longer controversial. There are, however, differing views as to whether companies should also provide their expectations of how their businesses will perform. Now, most research finds little evidence that earnings guidance systematically improves company valuations, increases shareholders' return, or reduces market volatility. Some even argue that forward earnings guidance can be harmful, focusing both financial market and company management attention on a short-term numbers game at the expense of long-term business fundamentals. Accordingly, a number of companies have stopped providing earnings guidance, with research finding that these companies see a subsequent increase in analyst forecast dispersion, so the range of forecasts around the mean, and a decrease in forecast accuracy, but no actual decrease or change in actual market volatility. Now, the main topic of my speech, the rest of my speech is really going to be about central bank communication and whether central bank communication is different. Now, central banks pursue transparency, and we do so first and foremost to be accountable in democratic societies. But our reasons for transparency go well beyond that. Research and experience demonstrate that clear and open communications also enhance the effectiveness of monetary policy. In particular, successful monetary policy requires transparency around two aspects: what we're trying to achieve and how we intend to go about achieving it. With respect to the former, Canada has benefited from a clear objective for monetary policy since the introduction of an explicit inflation target in 1991. As Canadians have come to understand the bank's policy objective and have gained confidence in its attainment over time, inflation expectations have become firmly anchored around that 2% target. And it's this confidence which allows households and firms to make longer-term plans with greater confidence, aligning savings, investment, and spending decisions with a common inflation control objective. These actions collectively serve to make the inflation target self-reinforcing. They also give the Bank of Canada greater latitude to respond aggressively to economic shocks without fear of dislodging longer-term inflation expectations. In short, the common understanding of our monetary policy objective makes its attainment easier. Of course, it would be quite remarkable if simply communicating the monetary policy objective were sufficient to ensure its achievement. The conduct of policy obviously matters. Now, the Bank of Canada implements monetary policy through changes in the overnight interest rate, which has a limited direct effect on savings, investment, and spending decisions. Far more important is the impact of the bank's actions on a broader spectrum of market interest rates, domestic asset prices, and of course the exchange rate. What matters to these asset prices, however, is not so much the current setting of the policy interest rate, but rather the expected path over time. Thus, monetary policy affects the economy primarily through policy rate expectations. The more those expectations are aligned with the policy path necessary to achieve the inflation target, the higher the probability that the inflation target will be achieved. Over time, the Bank of Canada has become significantly more transparent. Our communications are designed to both report our views on the forces at work in the Canadian economy and to help households, firms, and financial market participants understand how the bank will respond to these forces over time. The goal here, in effect, is to allow markets and the public to think along with us at the bank, not only promoting the appropriate formation of policy expectations given current information, but also allowing those expectations to evolve efficiently as new information is received. Now, we'd have an easy time if simply communicating our so-called reaction function, in other words, how we respond to economic circumstances. It'd be easy if we could just communicate that and if we just followed a simple mechanical rule. But achieving our target requires that we take a flexible approach, one informed by considered analysis and judgment. And that's one reason why transparency and occasionally guidance matters. In a perfect world, guidance would be unnecessary. The inherent uncertainty in economic outcomes and thus in the policy path would be widely understood. With full information and efficient markets, monetary policy expectations would effectively take care of themselves. In other words, knowing a central bank's inflation objective and its reaction function would be sufficient for markets and the public to form and, importantly, evolve their expectations without the need for any direct guidance from the central bank. In the real world, monetary policy guidance can be useful in providing additional information. But that additional information or the effectiveness of this guidance isn't assured, and the question of how to get guidance right remains a subject of considerable debate. One approach favored by some central banks at some times is to provide advanced signals to markets using stock phrases or code words. And not surprisingly, this sort of signaling helps market participants predict policy decisions in the near term, but it's not clear that fulfilling promises helps market participants understand why those decisions are taken. And without this understanding, market participants may be even less able to form efficient expectations over time, thus increasing their reliance on explicit guidance from the central bank. Ultimately, the risk is that markets turn into an echo chamber to the benefit of no one. Some other central banks directly disclose their policy interest rate forecast. This idea of sort of putting it all out there is on its face appealing. It avoids the challenge of trying to perfectly calibrate verbal guidance, and it also makes it easier to illustrate how monetary policy interacts with the economy. But in practice, it doesn't appear that the markets take systematic account of guidance offered by a published path beyond the very near term. And overall, research has generally found that publishing a path doesn't necessarily lead to better outcomes. Now, the Bank of Canada occasionally provides guidance in normal times to give some sense of the imminence and degree of prospective policy action. We seek to place that guidance in the context of the most important economic and financial factors that will determine whether that guidance is prophetic. This guidance is never a promise, however. Actual policy will always respond to the economic and financial outlook as it evolves. And market expectations of policy should do the same, reflecting differences in perspectives on the economic outlook amid a common understanding of our inflation target objective. So let me offer some specific examples of where guidance in normal times, in our opinion, can be helpful. And I'll start with something that happened, some guidance that we provided during the spring and summer of last year. At this point, it became clear that at least some Canadian market participants were making the shorthand assumption that the bank's policy interest rate needed to be at neutral when inflation was on target and the output gap was closed. It wasn't fully appreciated that in an environment of material headwinds, and in our case the material headwinds were from abroad, that these last two conditions, in other words, the interest rate being up at the neutral level and the output gap being closed, the economy operating at full potential, that those conditions would only be satisfied if the policy rate itself remained more stimulative to offset that impact of weaker foreign demand on the domestic economy. So to clarify our approach and to guide market participants, we inserted a box in our July monetary policy report. And this helped reduce unrealistic views of the potential pace of future tightening. A second example, this is more relevant today, concerns the links between price and financial stability. The Bank of Canada's flexible inflation targeting framework requires that we reevaluate and communicate our view of the optimal path for returning inflation to target, taking due consideration of the consequences for volatility of that strategy for output and in financial markets and the financial system more broadly. I think we all learned that through the global crisis that economic and financial stability are inextricably linked, and that pursuing the first without due regard to the second risks achieving neither. And while the primary tools to deal with financial stability are micro and macro prudential regulation and supervision, it may be appropriate in some circumstances for monetary policy to contribute to financial stability directly by complementing macroprudential policy. In current circumstances, the Bank of Canada may want to set interest rates higher than would otherwise be warranted to bring inflation back to target within the typical 6 to 8 quarter time frame. But that flexibility does not exist in a vacuum, and it should never be used by stealth. The evolution of household imbalances in Canada may be a factor affecting the timing and degree of any withdrawal of monetary stimulus. But if the bank were to lean against such imbalances, we would clearly say that we are doing so and indicate how much longer we expect it would take for inflation to return to that 2% target. Our current guidance indicates that some policy action may be necessary, and this encourages a degree of prudence in household borrowing. Indeed, in response, the share of new fixed-rate mortgages has almost doubled to 90% this year, reflecting, in our view, a combination of attractively priced fixed-rate mortgages themselves and the tightening bias of the Bank of Canada. Now, while we believe that it's appropriate to be sparing in forward guidance in normal times, the calculus changes under extraordinary ones. So when conventional monetary policy has been exhausted at the zero lower bound, any additional stimulus is, by definition, is impossible to achieve using the conventional interest rate tool. An extraordinary forward guidance is one unconventional policy tool to provide any additional stimulus that's needed, along with quantitative and credit easing. And the Bank of Canada used extraordinary forward guidance in April 2009 when the policy interest rate was at its lowest possible level, 25 basis points, and at that point when additional stimulus was needed. At that time, we committed to holding the policy rate to this level of 25 basis points through the end of the second quarter of 2010, 15 months hence, conditional on the outlook for inflation. In effect, what we did is we substituted duration and greater certainty regarding the interest rate outlook. We substituted that for the negative interest rate that would have been warranted at the time, but obviously could not have been delivered. The bank's conditional commitment succeeded in changing market expectations of the future path of interest rates, providing the desired stimulus and thereby underpinning a rebound in growth and inflation back to target in Canada. Our conditional commitment worked because it was exceptional, explicit, and anchored in a highly credible inflation targeting framework. It also worked because we in effect put our money where our mouths were by extending the almost $30 billion in exceptional liquidity programs we had in place for the duration of the conditional commitment. And finally, the conditional commitment worked because it reached beyond conventional central bank watchers to make a clear, simple statement directly to Canadians. Now, obviously, in different circumstances, different central banks, the optimal path for policy will depend, or will vary. And I'll take the example of the Federal Reserve earlier this past September, when it indicated that its policy rate could be expected to remain at exceptionally low levels until the middle of 2015, and when the Fed provided at the same time additional certainty with respect to its reaction function by linking future unconventional monetary policy to substantial improvements in the outlook for the U.S. labor market. Further, the Fed indicated that it would leave in place highly accommodative policy for, and I quote, for a considerable time after the economic recovery strengthens, end quote. The Fed also expanded its large-scale asset purchases, dubbed QE3, consistent with this enhanced forward guidance. The Fed's actions suggest that doing more, so extending beyond a conditional commitment as the Bank of Canada did, they suggest that doing more may require overcoming what has been a familiar monetary policy challenge of time inconsistency. But I'd suggest that it's a time inconsistency problem, not as it's been conventionally understood. Today, to achieve a better path for an economy over time, a central bank may need to commit credibly to maintain highly accommodative policy even after the economy and potentially inflation picks up. Many market participants may doubt the willingness of an inflation-targeting central bank to respect this commitment if inflation goes temporarily above target. And these doubts themselves reduce the effective stimulus of the commitment and delay the recovery. So to tie its hands, a central bank could publicly announce a precise numerical thresholds for inflation and unemployment or other vectors that must be met before reducing stimulus. This could reinforce the central bank's commitment to stimulative policy in the future and thus enhance the stimulative impact of the bank's policies in the present, helping the economy escape from the liquidity trap. Now, from the Bank of Canada's perspective, so-called thresholds, that which I just described, exhaust the guidance options available to a central bank operating under an flexible inflation targeting framework. If yet further stimulus were required, and communication were the tool to provide it, in our view, the policy framework itself would likely have to be changed. For example, adopting a nominal GDP level target could in many respects be more powerful than employing thresholds under flexible inflation targeting. This is because doing so would add history dependence to monetary policy. Under nominal GDP targeting, bygones are not bygones, and the central bank is compelled to make up for past misses on the path of nominal GDP. Bank of Canada research shows that under normal circumstances, so when a central bank is not at the zero lower bound, the gains from doing so, moving to a nominal GDP target, are likely to be modest and may be further diluted if key conditions are not met. Most notably, people must generally understand what the central bank is doing, and in the case of something like a nominal GDP target, that's an admittedly high bar. However, when policy rates are stuck at the zero lower bound, there could be a more favorable case for nominal GDP targeting. The exceptional nature of the situation and the magnitude of the output gaps and employment gaps involved could make such policy more credible and also easier to understand. Of course, the benefits of such a regime change would have to be weighed carefully against the effectiveness of other unconventional monetary policy measures that are available under a proven flexible inflation targeting framework. So let me conclude. Les entreprises peuvent parler de leurs résultats futurs, mais elles ne peuvent les garantir. Les banques centrales peuvent parler de l'orientation future de la politique monétaire, et elles peuvent, du moins au premier abord, tenir parole. So companies can talk about their future performance, but they can't guarantee its delivery. Central banks can talk about the future path of policy, and we can, at least on the surface, deliver. However, in ordinary times, achieving our objective will mean delivering a path of policy that adjusts as economic circumstances evolve. And therefore, that path cannot be predicted with certainty in advance. And in the Bank of Canada's view, that limits the effectiveness of policy guidance to relatively special circumstances. In extraordinary times, policy guidance may become more appropriate, as the bank has demonstrated with its conditional commitment. It also can be highly effective. In more extreme circumstances, even such a conditional commitment may prove insufficient. And in order to provide greater stimulus when at the zero lower bound, central banks can further restrain their future policy path through pre-commitment or history dependence, and in doing so provide greater stimulus. Now, in all cases, central banks must be mindful of the impact on financial stability of what amounts to a low for long interest rate environment. And this puts a premium on coordination amongst the relevant authorities to provide active macroprudential management. Our goal, as always, is to ensure that households, firms, and investors can make their decisions in a stable macro environment, and this will ensure that the fundamental analysis that CFAs perform every day plays a central role in capital allocation, business investment, and ultimately the creation of jobs and growth here in Canada. Thank you very much for your attention, and I'm happy to answer questions. Thank you. Questions for me?
Yes, thank you very much, Governor Carney. My name is Josephine Marks, and it's my pleasure to represent the CFA Society Toronto as Vice President to ask you a few questions. These have been provided to us in advance by our members. And I think the first couple pick up on the themes you covered, and then we'll stray a little further afield. So it seems as if international event risk, such as in Europe and in the US, have a strong influence on central bank confidence and actions. Can you comment on what you view as the most significant channel through which this event risk could affect the Canadian economy, and how you would balance this against domestic considerations in conducting monetary policy?
Okay, so you mentioned both Europe and the United States, and it's useful to have both in there because the channels are actually quite different. In any international shock, there's a direct channel through trade, there's often a financial channel, and then there's a more amorphous confidence channel. With respect to Europe, obviously the direct channel for Canada with Europe is relatively limited. And the direct financial links between the Canadian financial system and the European financial system is also relatively limited. But we would receive second-order effects through a sharp tightening of financial conditions if events in Europe were to turn out not as well as we expect. I almost said hope there, but I didn't say hope. We're expecting, our forecast has that the crisis in Europe is contained, and that ultimately, beyond our forecast horizon, there'll be a determination of the success or not of the relaunch of the euro. Anyway, so my point on Europe is that for Canada, the effects are largely confidence-related, would be largely confidence-related, with some element of tightening of financial conditions. And let me finish by saying that Europe is the single largest external risk to the Canadian economy. Vis-a-vis the United States, in the context of an American economy that has made considerable progress in rebuilding household balance sheets, repairing the housing market, repairing the core of the U.S. financial system, the risk that overhangs this is obviously related to fiscal policy in the short term. Our view is, and it's shared by many others, is that if there were not to be a resolution of the fiscal cliff, the U.S. economy would go into recession. And that would have a very direct impact on Canada. It would also have a material financial market impact. And the combination of the two would move us towards a less than optimal outcome. And depending on the persistence of the miss in the United States might necessitate a policy reaction. And obviously we can move quickly. So what we're dealing with in both those circumstances, and I'll get to the question now and conclude with the question. I wasn't trying to dodge it, but how do we actually, well, actually I was trying to dodge it, but now I realize, let me, but the net impact on policy is that those are relatively extreme events that would adjust our path of policy and are not incorporated into our expectations of the optimal path of policy right now. In other words, if we had a forecast that included a material deterioration of the European situation, or a forecast that incorporated the U.S. going over the fiscal cliff, we would have a different policy path. We do have a forecast which has basically stagnation in Europe, continued containment of their situation there, and a U.S. situation that is continuing to recover because some resolution of the fiscal cliff is involved.
The Bank of Canada manages the inflation rate between 1% and 3%, but the focus and discussion is always on the midpoint at 2%. So why not use the entire range between 1% and 3% for monetary policy? And while we're talking about it, why not add other targets like an employment target, such as used by the U.S. Federal Reserve?
Well, I guess on the second bit of it, our view is that, and our experience has been, that the best contribution of monetary policy to full employment is to provide certainty around the price level, low, stable, predictable inflation, so that businesses can invest, that households can save and spend with confidence about the path of inflation. And that is what has contributed. That has been our contribution to what in the end has been, and certainly through the crisis and coming out of the crisis, it's been an element of what is clearly a superior employment dynamics in the Canadian economy, and that actually was superior even in the run-up on a like-for-like basis analysis of the unemployment rate, for example, between Canada and the U.S. So we have one instrument, we can really target one variable, and we keep the focus on that. And that starts to answer the first part of the question, which is our agreement with the Government of Canada, which we renew every 5 years, and could change, but we renew every 5 years, since 2001, has explicitly said that we target a 2% target within that 1 to 3 band. The advantage of that is it's a focal point for expectations. And to the extent to which people have a view on what the inflation rate should be, and the extent to which forecasters or people are making projections, they will tend to use that 2%. That focus is self-reinforcing. As long as we're credible as doing our job, it makes the attainment of that objective more likely, and it's easier to focus in on a point than it is on a range. Now, last point I'll make is that there are always shocks to the economy, and the easiest ones to think about is short-term movements in the price of oil, which can have a hit on gas prices and therefore a hit short-term on up or down on CPI. And that means inflation will move within that band and occasionally above or below that band. What we shouldn't do as a central bank is try to respond to those short-term wiggles, because by doing so, we take that short-term volatility in the price level and spread it throughout the economy. And so that's the advantage of, a couple of the advantages of having the point and then the band around it.
Okay. So switching to the housing market, what are some of the potential mechanisms to alleviate the pressure on the banking system should house prices collapse? Would you describe house prices in Toronto and Vancouver as being unsustainably high? And what policies are in place to help mitigate the risk of a price collapse?
Right. Geez. It's hard. It can be hard to move around that one. First off, the first bit of that, or what are the mechanisms that help protect, I think was the term, right, the banking sector? I think the recognition is that with respect to the impact of any material move in real estate values, residential real estate values in Canada, that there is a built-in cushion for the private financial sector that's provided by mortgage insurance. I think, as everyone here would know, any high loan-to-value mortgage in Canada has to have mortgage insurance, which means that provided the underwriting standards have been met, which we're confident they have, that losses would go back to the provider of the insurer, which is ultimately backed by the Government of Canada. So it is a much more rapid transmission to the strongest credit in the country, which is, it's not the greatest thing in the world to happen, but it is the most efficient way to deal with problems in the real estate sector if they were to transpire. Now, that's not what we expect. We do have a view that there are some stretch valuations, in the residential markets in some of our major cities. And we've made that clear. The latest financial stability report, which came out last week, goes through this in some detail. Because of the macroprudential measures the government has taken, tightening mortgage insurance rules, because of the tightening of underwriting guidelines that OSFI has put in place, and we think a bit because of the tightening bias of the Bank of Canada, we are starting to see an adjustment in residential real estate, and the signals are still a bit mixed, so I wouldn't declare mission accomplished by any stretch, but we're somewhat encouraged by the direction that we're seeing, and that the prospect of a more sustainable evolution of the passive housing in Canada is within sight.
So following on that theme, are key measures and policies in place to prevent the 2008 financial crisis from happening again?
Well, we'll never be back in 2008, so it's going to be easy.
Similar crisis.
Internationally, I think that what I would say is that the system, the global financial system, is safer than it was. But it's not yet as safe as it needs to be, or as resilient as it needs to be. There has been substantial capital raised by the core of the banking system, $600 billion, substantially greater than losses realized thus far. $70 billion in capital raised here in Canada. There has been the shadow banking sector has fallen by about 20 percentage points of GDP back to 2004 levels. And we've seen substantial changes to market infrastructure, including to derivative and repo markets. There's a variety of things that have been done that directly address some of the shortcomings of the system that existed then. That said, the macro environment is much more challenging in major economies, Europe, potentially the United States, but certainly in Europe. And there are institutions that need to continue to build capital. And we haven't finished the reforms to derivative markets. And very importantly, we have not yet finished a series of measures that are necessary to end too big to fail and fully reinsert market discipline at the core of the system.
So how do you expect the Canadian banks to remain competitive on a global scale in the new Basel III world, given that the U.S. has declared that their banks are nowhere close to being compliant and Europe has not even committed to the January 2013 deadline?
Okay. I'm pretty sure the U.S. didn't declare that their banks are nowhere close to being compliant. I defy you to find that quote from a relative. Well, there's a couple of things. I mean, we actually, at the FSB, we met 2 weeks ago, 10 days ago, something like that, in New York. And we had exactly this discussion, and I'm happy to convey the outcome of that discussion. Vis-a-vis the United States, the U.S. is putting through its regs on a variety of aspects of banking, which include the implementation of Basel III. It includes a bunch of other things for so-called community banks and other aspects, and part of it is these other aspects, which is slowing down the promulgation of these regulations. But what the U.S. is doing, in fact, is stress testing its 19 largest banks, the large, complex financial institutions in their vernacular. Now, those 19 largest banks account for 90% of the banking assets in the United States. And they are stress testing them to Basel III standards and an accelerated implementation of Basel III. So the facts on the ground are that the core of the U.S. banking system has built capital. It's built around $300 billion of capital. It is being stress tested back to Basel III norms, and so the core, not just the core, but 90% of the U.S. Financial system is on a path to Basel III. Now, as every Canadian banker in this room would know, the Canadian banks are going one step further, because Canadian banks, as of basically now, but officially January 1st of next year, will meet the Basel III tests of 2019 at the start of 2013. And so there's a conscious decision of OSFI to accelerate the implementation of Basel III in Canada, which is being done for prudential reasons, but actually it's good for Canada, and it is a competitive advantage of the Canadian system. It reinforces the Canadian system. And as we stand here today, you're sitting, you and I are standing, but the Canadian banks have met that very stringent test. So the Americans are doing a lot more, and it is very glib to suggest otherwise. You're reading the question, but I think, and it is a mistake to view that. In Europe, the Basel III rules are going through the Parliament right now, and I met with the European officials in the last couple of weeks. It's slightly linked to their understanding of what the Americans are doing, I would say, but the intent is there to promulgate them over the first half of this year, and we at the FSB and others are watching closely to ensure that happens.
Okay. Well, thank you very much, and I believe Greg has some final comments.
Thank you very much.
Thank you.
Well, thank you, Governor Carney, for sharing with us today your views on both guidance and transparency. I think they were very informative and timely. On a personal note, I just wanted to mention to you that when I first heard of the governor's new appointment, I had sort of mixed emotions. I felt the loss that Canada, for Canada, but also I found myself feeling very proud as a Canadian, and especially a Canadian working in the financial services market. So we wish you well on your new role.